Welcome back, everybody. Today we're talking about depreciation and amortization. Most small business owners are very familiar with these terms, and they understand that there are certain things that they purchase that cannot be expensed fully in the year they are purchased, but they don't necessarily understand what has to be depreciated or even what amortization means. So today what I'm going to do is define depreciation and amortization, talk about what the IRS says you have to capitalize, which is the term that we use when we are talking about assets that need to be depreciated or amortized over time, and what you as a small business owner can do about it, because the reality of how we do these things is sometimes very different from the theory of how they are to be done. So I'm going to start off right away with depreciation. Now, depreciation is the recognition of an expense over time of a physical asset. So computers, office furniture, pieces of equipment. Now, for tax purposes, I depreciate most of this stuff using a method called MAKERS, which is essentially an accelerated form of depreciation in which you recognize more of the expense in the year that you purchase it, and then each year that diminishes until the asset is fully depreciated. And you also have to keep in mind that how we depreciate things for tax purposes may be different than how you depreciate them on your books for GAAP, generally accepted accounting principles purposes. So something to keep in mind. Now, amortization is a lot like depreciation, but it is the recognition of an expense over time for intangible assets. Now, intangible assets are assets that are not physical. So a very common example in the small business world of an intangible asset is something called a franchise fee. You are purchasing the rights and the territory and the branding to use a particular franchise, and it may be over 10 years, and that gets amortized equally over a straight line period for the life of that asset. So for example, a lot of franchise fees are for 10 years. You purchase the rights for $100,000 to use that branding, to use that territory for 10 years. That would mean we would take the $100,000, divide it by 10, and we would have $10,000 a year that you could amortize that asset over time. Now, what the IRS says must be capitalized is basically anything that you use for the business that lasts more than a year. So that is regardless of cost. That is why often sometimes I will see somebody who has depreciated a flower basket over 7 years that was only $10, because the IRS says it doesn't matter about cost. It only matters how long the company is going to own it. However, if you start depreciating $5 items here and $10 items there, that thing called a depreciation table on your tax return is going to get pretty ridiculous. And there are just some things that really don't need to be depreciated, even if they last you more than a year. But that's what the IRS says, which is where we come to the reality of it all. Now, as a small business owner, you can, as part of your operating agreement, bylaws, whatever, say, this is what we are depreciating. Here is our cost threshold. Now, it can vary from company to company. You have some very large companies who will say, we are not going to depreciate anything that is less than $5,000. Now, if you're a small business person who doesn't have an internal CFO or accounting team or financial individual helping you out here, you're really relying on your CPAs to figure out just what threshold you should be using in order to depreciate items. And you can actually get a wide plethora of opinions and tolerances as to what they consider a capitalized asset. For example, I have a CPA friend whose threshold is $2,000 or more is to be capitalized. Anything less than that, she expenses. For me, the threshold is $250. And the reason my threshold is that low is because I was representing a client during an audit one year, and the Internal Revenues Officer threshold for a capitalized asset was $250. So I'm not really sure what her reasoning is for $2,000. Maybe it's because they don't purchase a lot of $2,000 items. But the point is that those thresholds do tend to vary based on your tolerance and risk tolerance of your CPA. So just something to keep in mind. Now, I'm going to talk next week about Section 179, which is a special form of depreciation. And it takes a video all itself because it can be a little bit complicated. But know that while I'm telling you right now that there are some assets that you cannot depreciate in the same year, There is a rule that says you might be able to, as long as you qualify for certain criteria. So that'll be my video next week. Please, you guys, feel free to hit that like button, follow me on Facebook, YouTube, or even LinkedIn. I'm there as well. In the meantime, take care. Have a great week.